Morning, market chameleons, and soon to appear Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
Great. Last trading day of the week. Let's start with the disclaimer.
Okay. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. That's excellent. The disclaimer.
What are you seeing this morning, buddy?
All right. Let me share my screen. 1 second. Let me know if you see my screen.
It's there.
All right. So today, I think we'll quickly scan the pre-market, see what's moving in the pre-market hours. We wanted to get to SPY. I know we've been talking about it kind of all week, but we got distracted with some earnings, which is okay. But unless we have certain questions coming up, I'm going to try to answer those first. If we don't, after the pre-market report, I'll go to SPY, take a look at SPY from a few different perspectives with options and seasonality.
Great.
How does that sound?
Awesome.
Good. All right. So let's get started with the pre-market report. These are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Let's first take a look at what's going on in the higher market cap stocks. I'm going to use this filter, market cap. Let's filter market cap, $20 billion market cap or higher. I see 7 made the percentage gainers list, 17 on the percentage decliners list. So from that perspective, a little bit more bearish bias than bullish bias at the open, but these lists it's Friday, the lists are kind of small right now. And I don't see a lot of shares trading in pre-market hours. So you can see here 20,000 shares, 36,000 shares in the pre-market. So not a lot of activity from that perspective. Let me take a look at the unfiltered report really quickly. And we don't use these other filters. Sometimes if you just for example purposes, if you just wanted to take a look at what's moving on earnings, you could just click that. So then you get a list of stocks, that are up on earnings, stocks that are down on earnings. So here I just see, I'm just eyeballing to see some of the higher market cap stocks. So I see like Disney's in here up 1.5%. HUBS up almost 20%. Let me just take a look what that stock is. HubSpot. So,
man, every stock's over a couple $100.
Over they're all in the hundreds. And I think part of that might be just the way Robinhood kind of changed the industry, because I believe in Robinhood they kind of introduced you could just buy one share, right? Like one share of stock. It used to be you had to buy in round lots. So you had to buy 100 shares, in round lots. You couldn't buy less than 100 shares because that would be considered an odd lot. I think now that changed. So now you're seeing like an influx of a person who, I could just afford one share, which is $500. Before you'd have to come up with thousands of dollars. So, and I know just my wife is saying she went to a girlfriend's party and they ordered on this happened like 2 weeks ago or something like that. They Will, you there?
Yeah, I'm here.
They ordered.
Yep. My mouse dropped. I didn't want to.
They ordered like one of those pay-per-view fights, and it was a bunch of girls, and they were just sitting on Robinhood looking for stocks to buy, upcoming Monday.
So that's incredible.
Yeah, but
is that a sign of a top, or just a sign of a new excited market? Who knows?
I don't know, but they were actually pretty excited because they said that before the Robinhood, they didn't feel like there was a path to make investments. Now they feel like, well, because because they could invest like a couple $100, like in one share here, there, one share there, it's for they're interested. Obviously, bull market helps because they're making money on it, but at the same time, they're learning about stocks and kind of learning about the stock market, as before it was very foreign to them. So it is bringing more people in and kind of helping them explore, investments and analyzing stock market. So it's interesting. We'll see how it plays out in the long term.
We got a question from a new person on the chat, Patrick D. He's asking, is there a way to look at the most active gainers, decliners, ETFs in the pre-market?
Yeah, you could do that too. So I'll show you how to do that next.
Great.
But here's HubSpot. Since I'm on there right now, let's just take a look at its history. So we see up 19.6% today. Not a lot of shares. Look, only 13,000 shares right now trading in the pre-market hours. Here, here's the news. I'll let you kind of go in there and read the news and interpret for yourself if that's justified or not. But let's take a look at it from a perspective of how it behaved historically after reporting earnings. So these are the last 12 quarters of earnings. These are the dates here. So we're right here. This is a current date. These are the historical dates. This is how it behaved before earnings. So we see, historically you had to run up into earnings, so it did pretty well. Especially like starting 2 weeks ahead of earnings, pretty good. 3 days ahead, day before. After reporting earnings, this is what it tended to do. From at the opening, it tended to be up 64% of the time versus down 36% of the time for an average gain of 2%. If we take just the opening gap moves in either direction, up or down, historically, that's on average 5.1%. So today, way above that. Again, just keep in mind that's not a lot of 13,000 shares trading, but it is a $500 stock. After the opening, this is what it tended to do the day of earnings. From the open to the high of the day, average move was 4.4%. From the open to the low of the day, average move was down 3.7%. So slightly skewed towards the upside. From the open to the close, historically drifted higher more often than lower. 73% of the time it drifted higher from the opening price, 27% of the time lower, for an average gain of 1.1%. So that's really quickly from a historical perspective in HubSpot. It did, just looking at it right here, coming out of earnings the following day, 2 days, it tended to be weaker. So you could see there it declined around 2% on average. So that's HubSpot really quickly. You said you did have a question about ETFs, so I'm going to get off this earnings here. So you could just click on this ETF. So this will filter out the comments. So ETFs, and then here are your biggest percentage gainers, biggest percentage decliners in the ETFs, most actives, and these are, you could sort these by any of these columns. So here, those are the POTX. I think those are the marijuana stocks or cannabis stocks. Yesterday they were down big, down 4.1% in the morning. So that's really quickly how to filter the ETFs. Of course, you could create your own watch list, filter by your own watch list, or just stocks in a certain ETF, like S&P 500. Hopefully that was helpful.
Yeah, that's great.
Well, let me know if you have questions on the pre-market, any other questions. If not, I'll just move on to SPY.
Yep, you can move on.
All right. So I have SPY skewed up because we did have, I think, almost in the beginning of the week, just to take a look at the SPY. But we had a lot of earnings, so we didn't get to it. Let's take a look at SPY today. Let's start out with valuation, because look, SPY near 52-week highs. You're starting to read reports, that valuations are starting to get stretched. Um, I think I saw like what the Warren Buffett indicators, like, starting to show up as being stretched. So let's just quickly take a look at that. And this is going to take this, what these financial ratios are doing is looking at the holdings in the SPY. Okay. So we're going to look at the holdings in the SPY, sum them all up like it was one company. So imagine like you just bought a company with all that's diversified everywhere in the economy, right? So instead of like a company like Exxon that just does oil, right? If you bought all the companies in the SPY, you got like this one big diversified company. And here are all the holdings below. So we could see here, if we look at total revenue of all these companies right now, 12.2 trillion. But those revenues year over year, that's declined by 1.5%. So some companies are doing pretty good in there. Some companies not doing so good. On aggregate, down 1.5%. And that you can see on the 3-year average up 4.5%, 5-year average 4.7%. So in the sales, obviously declining. A lot of it's due to coronavirus.
Yeah, well, it is amazing that number doesn't seem nearly as tragic as you would have thought a year ago.
You'd have thought, yeah. Well, there are a lot of companies
if we had discussed this a year ago,
yeah,
that the world was completely shutting down for a year.
Yeah.
It's
Well, what was interesting is like this here is getting pulled up by the most heavily weighted stocks. So the most heavily weighted stocks in the S&P 500, highest market cap, biggest, ones that earn the most, like Apple, Microsoft, Amazon, Google, Facebook, those companies have been doing well. So the stay-at-home economy actually probably gave them a bump, right? People were staying at home, ordering stuff on Amazon, using the internet more, using their iPhones more. So those companies got a bump to a high degree that it offset all these other companies that are not doing so well. All right. I think that's what's happening here. But you could see net income as a whole is down 25%, operating income down 1.3%. Operating revenue down 1.3%, operating income down 10.2%. So I'm going to quickly kind of go over these financials, explain them a little bit more. Then we're going to go take a look at SPY and how the options are set up, what we think might come upcoming in March, what may happen based on historical trends. So here, this is new operating income, and the difference between operating income and net income is that a company has income that it generates from its core business, which we call operating income. So from its day-to-day business, it generates a certain amount of income and revenue, right? Like, for example, eBay, their core business is generating fees on, matching up buyers and sellers, so that'll be considered like, say, its core business. But at the same time, its net income could be increasing or decreasing because of other ventures they have. Like maybe they have, they sell a building that they own for 10 years and they made a profit, so they made income on that. But that's not part of their core operating income because that's not what they do day to day. Okay, so operating income is kind of like that's where how much income are they making from their core business. Then you got net income that includes everything, their investments, their like one-time gains, one-time losses, write-offs, depreciation, all that's coming from the net income. Okay, so let me know if you have questions on that, Will, because I'm going to be referencing, as we go along, and I promise everybody I'm going to start hitting more on those financials as we go further. But let's take a look at SPY's PE. So this is its price to earnings multiple. So if we took SPY, we took all the companies in SPY, all the holdings in S&P 500, and we took the entire market cap and we divided it by the total trailing 12 months earnings, we get this PE ratio. So that's trading 35 times. The market cap is 35 times its annual earnings. Okay. That compares to a 3-year average of around 28 and a 5-year average of 27. So we can see that those multiples have expanded. Price to sales, that's market cap. This is P's earnings. Price to sales, that's looking at market cap divided by total revenue, right? So we got total, right? Whatever, all, if you summed up all the market cap of all the stocks divided by all the revenue that all of them generate, we're looking at 2.8 times its multiple. That compares to 3-year average 2.6 and 5-year average 2.4. This is price to cash. So it's looking at the market cap versus how much cash they have on the books. Right now, that actually improved. That multiple is not as high as the 3-year average. We're at 9 versus 3-year average 11.4, 5-year average 10.8. Price to book. So this is the book value would be considered if we took the total assets of these companies and we subtracted to total liabilities, how much is left over in a liquidation to give to the shareholders, right? So if you bought the companies and you just said, I'm going to sell all the assets, pay off all the debt, what's left over, and then we take a multiple for that, price to book, right now 12.8, similar, close to the 3-year average, a little bit above that 5-year average. Price to EBIT, that's market cap over earnings before interest and taxes, similar to earnings, but that's before interest and taxes. Price to EBITDA, I'm going to go a little bit faster here. That's price before earnings before interest, taxes, depreciation, and amortization. Here's the operating income we just talked about. That's at 25.3 compared to a 3-year average 21, 5-year average 20. So we see here that on average, those multiples relative to what they're earning have stretched, right? We're above the 3-year averages all here, right? Those have stretched out. So we are historically, we're at higher multiples. Gross margins, that's where if we take the revenue minus cost of goods sold, right? That's your gross profits there. So as a percentage of revenue, right now we're at 31.5 for S&P, which is close to where the 3-year, 5-year average is, slightly lower. Net margins, that's your net earnings after you pay all your expenses and taxes, as a percentage of revenue at 8%. That compares to, which is lower than the 3-year average and 5-year average. Operating margin, again, that's what we just mentioned. Right now, operating margin is a percentage of total revenue. We're at 11.8% compared to 3-year average 12.9, 5-year average 12.8. So we see that's declined, right? Let me come down here to the yields, explain these, and then I'm going to start looking at, then I'll make my point, and then we'll go look at the SPY. So earnings yield, this is saying that if you bought all these companies, right, for the market price, today's market price, and outright, and you got to keep the net earnings, right? How much are you yielding on your investment? So that is right now 2.8% compared to 3-year average 3.6, 5-year average 3.8. So let me just make the point. Let's say if I bought a house for $100,000, rental property, okay, for $100,000, the rent is $10,000, right, a year, let's say after my expenses. Well, that means I'm yielding 10% per year, right? So if I'm going to make $10,000 every year and I paid $100,000, that's like a 10% yield. Now, that yield could go up or down based on two factors. One is if I pay for the same house, if I pay $200,000 and I still make $10,000 a year, now my yield's only 5%. Okay. So one factor is the price you're paying. The other one is if the rent is going up or down. So if I paid $100,000 for the house and the rent fell to $5,000, I can't get the same rent. Now I'm yielding only 5%. Okay. So there are a couple factors here that will impact this price and the ability to earn on that asset. So right now we're at 2.8%. So it's lower than the 3-year average, 5-year average. This is the yield, earnings before income and taxes, earnings before income taxes, depreciation, then operating yield, 3.9% versus, you can see here, 3-year average, 4.7, 5-year average, 5%. Now, another reason why this yield, why people might be paying more, is interest rates. So, of course, if you're buying an asset, sometimes you're going to buy it all cash, but it's your ability to borrow money and buy that asset. So if interest rates have fallen, right, now it costs, you could borrow money and it costs you less money to buy that asset, then that yield, that return, you'd expect to be lower than when interest rates are higher. So if interest rates are higher, right, you have two things going on. First of all, it could cost you more money to buy that asset, and you're paying more interest, so you require, a higher return on your investment. Also, you could forego investing, because if you could earn more money in a bank, you would rather go to the risk-free rate and earn there than putting on a risky asset. So again, this also, you got to keep, what is the spread between the risk-free rate and the yield on the risk asset. Hopefully all that's kind of making sense right now. But in general, we're seeing that we are stretched, right? Right now, if we are looking at the valuations, we're stretched. Another thing is, it doesn't look to me that this growth right now is broad-based, not as of yet. So some companies in there are doing pretty good, but as a whole, that growth hasn't spread out to the entire economy. So can we come in for a correction? That's where we're looking at. Even in a bull market, we could have a healthy correction. So let's see when potentially a correction can come. So I'm going to go here to the tools here, take a look at seasonality. And let me know if you have questions, Will.
I will.
So here's how SPY, or the S&P 500, how it behaved historically by calendar month. So we see here, it's broken down by different months, right? January, February, March, April, May, June. These are the years going back 10 years. So here we have the statistics. So we see in January, on average, SPY went up more often than not, 54% of the time up, 45% down. On average, it gained 1.4%, and so on. So you could see the stats, for each calendar month. So this is how it tended to do. Of course, if you get news could come up at any time that could change that, but this is how it tended to do. So we see, if I just picked out the best historical months, it looked like April here. July was pretty good. Then we get November's pretty good. So the weaker months, I'm just eyeballing March. So half the time in March it was up, half the time it was down. Also over here, September look as the weaker months out of the year. So we're coming up on March. If we see any kind of correction, potentially March there seems, from a historical perspective, that it could be a potential month there that we can correct. And I'm not saying we're going to a bear market. I'm just saying that even in bull markets, markets will correct, right? They don't always just go straight up. So that's just kind of eyeballing here and setting up and I'm only taking the perspective right now of, one side, when might a correction come. you could also make a case for just bullish as well. But let's say if we think that March has a potential to correct, let's take a look at the options markets and see what kind of setup we could look at for that, for that outlook. And Will, let me know if you see, because I don't see the questions coming in on the side.
Jake actually just asked 2x big data in season Tesla last July. Oh, he's mentioned something. He said Jake's just saying make sure you take seasonality with like anything, right? They're numbers. You may have had 10 great, years in a row, but the 11th, you just got to be careful when looking at all numbers, obviously.
It's just one, right? It's just one metric in all the metrics that you look at to kind of give you guidance. So you can't take any one metric. You have to look at everything as a whole. So for example, if I was a real estate developer and I looked at, should I build condos in this one zip code? I could start looking at different metrics, and I could say, well, how's the population growth? Well, the population has grown here, more than national average. Well, that's good. Then I could look at another metric and say, well, how are the incomes? Well, the incomes are declining in this area. Well, that's bad. Then you could look at how's the inventory of these places. So remember, there's no one metric. You're just looking at the data, sifting through it, and trying to create a picture for yourself of what I think is more likely to happen. All right. So I think that's what Jake is saying, that yes, there's no one magic pill or one magic. There's never like that. That doesn't exist. You're looking at the data, you're doing your research and trying to picture, giving yourself a little bit of an edge, saying what I think is more likely to happen. Does that make sense?
Yeah, that's great.
Yeah. All right, so let's take a look at the benchmarks right now in SPY. One way to play it is like this. SPY may correct 5%, 10%, but we are in a bull market, and we have another thing going on where it's kind of inflation driven, and a lot of people are coming in there, and we have seen prices right now unusually very liquid to the upside, right? So prices could be liquid to the upside, but on a correction, they could also be illiquid to the downside. So if you're looking at a big move in either direction, right? In either direction, then we could take a look at the straddle. So straddle is buying a call and buying a put with the outlook that it could move a lot in either direction. So here for 30-day maturity, we see an at the money straddle. So these are options with 30 days to go to maturity right now, that the premium as relative to the stock price, right now you would be paying 3.8%. By the call, by the put, it would be 3%, 3.8% premium as a percentage of stock price. In the last 52 weeks, that has been 5.8%. So you see implied vols have come in. That's at a 2%. That's 2% below that 52-week average. If you go out a little bit further, 60 days, that straddles 6% versus 52-week average 8.2. 90 days out, we're looking at 7.8% premium versus 52-week average 10.1. And 120 days out, we're looking at a 9.4% premium versus 52-week average 11.7. So you could see on a relative basis, those straddles are less expensive than they were on average in the last 52 weeks. Another way you could do a strangle. I'm going to show another, as we're going along.
What happens if I just wanted to buy a put? Can I look at that?
Yeah, you could take a look just at a put, for example. Here, like a long put. So here's a put that is at the money. right? 30 days out, that'll cost you 1.9% versus 52-week average 2.9. Here's a put that's 5% out of the money, right? So it's not at the money, it's an out of the money put, 5% out, 30 days to go. That'll cost you 0.8% premium as a percentage of stock price versus 52-week average 1.5. And then you could go down here. We're kind of running out of time. Sorry, we hit 9:30, but I'll continue this on next week. Are we closed?
Wow, that went quick.
Yeah. I believe though that Monday we're closed on Monday, I think.
I think Monday may be a holiday. Yes.
Yeah. So if we're closed on Monday, then Tuesday we'll take a look at it on Tuesday and continue. And I'll go to the options chain and we'll set up some of these strategies.
All right. Great job, D. Thanks for joining everyone. Have a safe trading day and a great weekend. Thanks, buddy.